Hi, everybody. This is Seth Martin with the Middle Class Investor. Thanks for joining me again this week. Today, what I'd like to talk to you about is risk again. We talked a little bit about risk the other day and how to control risk. This is going to be a little bit more, we hear this term a lot, bubbles in the market. We hear people talking about bubbles and what are they talking about? It's kind of a mystery, right? So, one of the areas where there's a pretty big bubble is in the bond market. So, how do we know this? Where does this come from? Maybe we could put a little explanation behind it. So, what I've got up here is a chart. It's actually two charts. I'm going to zoom in on it a little bit. The chart in black is the S&P 500, going back here to the early 60s. And then the chart in blue, this one right here, this is the 10-year Treasury. So the 10-year Treasury is, you hear that term a lot. So, what is the 10-year Treasury? Why is it so important? Why are people talking about it so much? Well, the 10-year Treasury is basically 10-year government bonds. So we all know that the U.S. government is spending more than it makes, okay? And the way the government makes money is it collects taxes, right? So we bring in, I'm just, don't hold me to these numbers, but it's about about $3 trillion a year, but we spend, or maybe we bring in $3.2 trillion a year, but we spend closer to 3.8, almost $4 trillion a year. So we're spending roughly 600 billion, more than we're taking in tax revenue. At the peak of the financial crisis, we were taking in 2.8 trillion and spending 3.8 trillion, something like that. So how do we do this? How does this happen? If you or me were to run our finances like that, it wouldn't be too long before we'd be bankrupt. Well, the U.S. government does this. The way it's allowed to do this, and not everybody in the world is happy about it, let's say that, is after World War II, the U.S. dollar became what's known as the world reserve currency. Now, we can get off in the weeds here with these terms, but I want to make sure that people understand, why these things are important and why we're at critical junctures, in our lifetimes. At least that's my opinion, okay? So everybody has an opinion. We all know what people say about that. But this dollar standard in the world, or the reserve currency as it's known, what that basically allows us to do is we trade with other countries. And if we buy goods, then money, U.S. dollars, leave the United States for those goods, and then the goods come to us. And if we sell goods, then goods leave the United States, and we're paid in some currency, let's say euros. And all the countries, as we trade with one another, we have what we call current accounts. And you'll typically hear ours referred to as the current account deficit. And the reason it's called the current account deficit is because in the last 30 years, it's been a deficit every month. So we don't have a surplus. We have a deficit. So what does that mean? How does that manifest itself in the world economy? Well, what happens is, let's say we trade with China, okay? And we buy T-shirts from China. Just look at around your house, look at your car, there's lots of things that this country buys from China. Well, China actually produces those goods, right? They have people employed, they have capital and machinery that they've invested in, and that capital machinery, that capital stock is producing goods and services. And then what happens is, what are we producing? What is the U.S. producing? Well, we still produce quite a bit. I mean, we still have a very, very large economy. But net, we don't produce near as much. We have more of a service economy and a retail economy. So we're not producing as many things that the world wants to buy as we used to. So what happens? Well, when we have this current account deficit with China, so basically we owe China money, right? They send us more goods than we send them money, and the deficit is what we owe them. Now, what the U.S. dollar reserve currency allows us to do, and it's not really a great thing. It's a privilege that we have, but we've been abusing it for some time. And so what we do is we just basically, give China bonds or give them cash. So we pay them back with money that's printed or bonds that are created out of thin air, and they take those. They basically buy bonds with it. Okay, so we basically. Because they have to turn around and oil, for example, is traded in U.S. dollars. If you want to buy a barrel of oil somewhere in the world, you have to use U.S. dollars. So what we do is, these countries send us real goods, and we send them U.S. dollars that we basically create. Okay, and this balance, this activity, it shows up in our bond yields. Okay, so as China has more or less appetite for those bonds, then the yields go up or down. Okay, the price of the bonds go up or down in the market. So basically, if you look at this chart, and of course this isn't all China. Okay, this is going all the way to the 80s. I mean, every country in the world has U.S. dollars in reserve. Okay, every country. And the way they got those dollars, and they have them, they don't have them just in dollar bills. They have them in denominated in bonds. Okay, but the bond market is generally considered very liquid, and so they could trade those bonds and turn them into dollars readily. But every country in the world has these. So, and as you can see, for years, 30 years now, 30 plus years, it's been a pretty good deal for China and these other places around the world to hold U.S. bonds. But here's the deal. Most of you out there, if you go take an inventory of your 401k, your IRAs, and things of that nature, you don't have bonds likely. Well, probably definitely you don't have bonds. But you're in a bond. You might be in a bond fund. Okay, so it's important to understand the difference between a bond fund and actually owning a bond. So if you own a bond, let's say for example you had a $1,000 bond and you bought it 10 years ago. Well, what that means is you probably bought it for let's say $500. Okay, and then it has a certain yield every year, 3% or something like that, and then what happens is if you hold it to maturity, in other words, you hold it the full 10 years, then you can redeem it for $1,000. And so you got to make $500 plus you got to make, say, 3% a year, as an example. But in a bond fund, you have a bunch of different bonds with different maturities. So you might have some that mature in a year, some that might mature in 2 years, 3 years, 5, 7, 10, 20, 30 years. And the problem is, as the interest rates start to tick up, especially those long-dated bonds, they start losing a lot of value very rapidly. And if you have a bunch of those bonds in your bond fund, then your bond fund can go down in value very rapidly. So, if you're ever, I don't know, different companies have different resources tied to their 401k and stuff in terms of what kind of information you can get. But if you're ever sitting down and talking to somebody who administers your fund or something like that, you could ask them, what's the average maturity in this bond fund? And in this environment, what you want them to say is like 2 years or less, 3 years or something or less. If they start giving you numbers like 10 years and things like that, that's a lot of risk. Okay, and so what I want to try to help you do is understand where that risk might be, and then help you, make some decisions around what to do about it. Now, let's back up again. The 10-year Treasury, sometimes called the risk-free rate, it's not really risk-free, but it's backed by the U.S. government, so it's generally perceived to be risk-free. Nothing is risk-free, so that's not really an accurate statement, but it's widely believed that that's the case. But the reason this particular note is so important is because, especially with the housing market, it's what your mortgage rates are based on. And this is one of the reasons the Fed has been so active in this market, is because we took a real hit in the mortgage market. House prices really dropped dramatically, especially in some markets. Not in I live in Texas, and they haven't dropped significantly in Texas, but other places in the country like Las Vegas and Florida, California, New York, those places took real hits in their markets. And so the Fed has taken a real active role in trying to keep those rates low to help the housing market come back. And so this is generally agreed upon as to why the rates keep going lower and lower. I mean, these rates are lower than they've ever been in history. This low down here was lower than ever. So the Fed has been very, very active in the market and has really had a big impact on the market. Now the question is, as these rates go higher, the bonds are going to go down in price. So how is the Fed going to, who are they going to sell these bonds to? I mean, that's the real conundrum that the Fed has got themselves into. But, I mean, you and I can't worry about that. I mean, we don't have any control over that. All we can do is kind of protect ourselves and make sure that we don't experience any of those problems. So what might we look for in the bond market? Let's zoom in here for a second and see what we might look for in the bond market. So here's the rate as it went up, and if this is in fact the low, okay, the 30-year trend is reversing and this is the low, then what we should see is the market pull back, probably between here and here somewhere, and then start to turn back up. And I would say that if it turns back up and gets above this previous high, you should be looking to get out of those bond funds, because that would signal a potential trend reversal. And like I said earlier, that change in trend could be very dramatic at first. So one of the things we could look at, one of the things I want to look at is this chart here. This is the 10-year Treasury going all the way back to 1870. And you can see this run-up here into 1981 was pretty significant. And mainly the reason we had this run-up into this is we went into huge debt during World War II. And, we had huge debt in our country. And this move here was to, interest rates had to go up because we had to service this debt. What we ended up basically doing was inflating this debt away. As you recall, inflation was very, very high going into this peak here. And then we broke the back of inflation. The U.S. government was a good place to loan money to again, and then you started having this downward tick in yields or interest rates. But what I want to point out here that's important is you have a high, you have a low, you have a lower high, a lower low, a lower high, a lower low, a lower high. So this is a trend. This is the definition of a trend when you have these lower highs and lower lows, okay? Definition of a downtrend in this case. But if this is the low, if this is the low of this move here, this 30-something year move, then what you could expect to happen is the market to pull back, make a higher low, so it won't make a new low, it won't come down here, it'll stop in this area here and then turn and go higher. If it turns and goes higher, this is likely a trend reversal. And if you own bond funds, you are not going to want to own those bond funds during this period. So just keep that in mind. Go ahead and take a little inventory. It's nothing to panic about. We've got plenty of time to manage that type of stuff. But I want to point these things out to you guys each week, because these are areas that can really hurt your retirement accounts. And like I said, those initial moves can be some of the biggest ones, and so you end up losing, a ton of money in the first, 6 months. Before you even get statements roll in, you've lost tons of money. So, and I don't want that to happen to anybody. That's no fun. That's not. It's hard to think about retirement when you're worried about that kind of stuff. So that's about it for this week. Until next time, you guys tell your friends about the Middle Class Investor. Forward them a link. Like the page. Comment. You can write me. I'll write you back if you've got specific questions. If we get enough of the same type of questions, we might just do a video on it. I'm trying to do things each week and each time that I think people could use, but certainly if there's something you want to know more about or you want to talk about in these videos, we can certainly do that. So until next time, thanks for visiting the Middle Class Investor. We'll talk to you guys soon. Thanks a lot.